we'll discuss a lot more on retirement and then cover what riders have to offer as far as life insurance is concerned. Let me see how this works. Okay, yeah. So I think, first of all, since we're talking 40 over 40, and, retirement planning is, what is the theme of the session? We'll and talk a lot more about retirement first, right? So, what is the big thing that we are all talking about? That, India is moving through this phase where it is growing very, very rapidly, right? A 1 trillion economy to 2 trillion, first trillion took us 67 years, right? The next trillion, by the time we hit the 75th year, right? We're 2 trillion and now moving to 3.5 trillion, 5 trillion, right? So, a lot of it is the economy is growing. It's growing on the manufacturing side, the servicing side, but more importantly, right, money is something that fuels the entire economy. So a lot of financialization of savings is happening, and there are other elements, right? If you look at the middle income segment, right, we're not talking bottom of the pyramid, but the middle income segment, that is going to grow significantly. And Goldman Sachs recently had a report in terms of that this segment is going to propel the next phase of economic growth. Right now, we have a younger demographic. A younger demographic has very different lifestyle needs, right? So people at 30 today will need to plan for retirement very, very differently from people at the age of 50 or 55, 60, right? So based on where you are in your life stage, the retirement planning advice will differ. And lastly, the per capita income is going to go up, right? So a lot of things that was spoken, let's say in the other sessions as well, because of this financialization, a lot of money or wealth is going to come in. But, in a contradictory manner, India's net savings of Indian households has gone down. India was largely a savings economy, but what has happened is, during the COVID era, of course, a lot of us were working from home and so on and so forth and not spending as much. So, the savings rate did go up, and it grew up in other markets like the US and some of the other European developed markets as well. It happened in India, but now it's come crashing down because, and all of us are aware, right? If you look at the hotel prices, they've gone up. If you look at the airline prices, they've gone up. People want to travel a lot. People are spending a lot more, right? Which means that unsecured lending has gone up, credit card debt has gone up, and savings has come down, right? This has implications over a longer term perspective, right? We all speak about the power of compounding, but the power of compounding needs some raw material, right? Which is savings. So, any retirement plan that you're thinking about has to first start with saving up certain corpus, right? So, if the per capita income is going to go up, but you're going to acquire more debt and save less, retirement planning cannot happen, right? So I think that's very, very important. I think this chart essentially shows, right, where we stand today versus the rest of the world. So if you look at the GDP of the country, right, look at the developed markets like Canada, USA, Australia. Pension funds, right, these could be endowment funds run by educational institutes or states like California and so on and so forth. They are the largest, vehicles for holding long-term assets or pension funds. As a percentage of GDP, it's almost, if you move to a developed economy curve, that number has to move to about 100% of the economy. In India, it's only 3%, right? Because, of course, our per capita is low. That's given, right? So we are spending as a country, Indian households would spend a lot on subsistence, right? So roti, kapda, pani. Roti, kapda, makan, right? That's where we start, right? And then you get into some of the lifestyle requirements, right? Which is, you start with maybe the kids' education, marriage in the family related, and then get into, lifestyle events. And after that, we're thinking about retirement, right? It's not even in the mindset. That's the reason that people are saving extremely less for retirement, right? And there's no better graph that showcases that than the one which is there on the right, right? Now you look at this gap, right? So, and what does this gap mean, right? What does the retirement gap actually mean? So let's say you're retiring at the age of 60 and you are earning 1 lakh rupees. So we assume at least 70% of what you are earning you need to have as your income, right? Right? So 70,000, let's say, per month is something that you need to continue earning.
Now, of course, you have some fixed deposits, some savings, some dividends which are coming to you, some bonds in which you have invested. Now that is kind of giving you some money. Let's say that money is 30,000 rupees, right? So this gap is 70,000 minus 30,000 or 40,000 rupees, right? On a monthly basis, right? So on an annualized basis, that gap is 5 lakhs, and so on and so forth. Now this is like 1 lakh, right? If you're earning 5 lakhs and you need to actually have 3,50,000 worth of income every month to kind of ensure that your lifestyle sustains, right? Current lifestyle sustains, then you will need 3,50,000, right? And therefore you need instruments which are actually giving you an income of 3,50,000 every month. So that's the way to think about it. So this gap in India and China is amongst the largest, right? I mean, it's exactly the opposite, right? If you look at India is on the left side here, and it's on the right side of that graph, right? Effectively, this gap is so huge right now, 95.7, right? Right? So, I mean, that is effectively what the chart is showing, and it means that a lot of Indian households need to start planning for retirement and saving for retirement. And we are not talking instruments here, okay? If you think you want to put in equity, put in equity. If you think you want to put in a real estate or a property as your retirement objective, go there. If you think you want to put in a national pension scheme, go ahead and put money there. If you think you have a vehicle which is like a insurance policy as your retirement thing, put some money there, right? So this is independent of the instrument, but start planning for retirement. I think that's the first message. The other thing, elderly population is going up, right? So we are all going to live longer than our ancestors. I mean, just pre-independence, the average age, right, of an Indian was about 40 years. 40 years, okay? And 75, 80 years after that, we are talking 40 after 40, right? Which means that the average lifespan is going to double. So if you were living, an average Indian was living for 40 years, I mean, that is now going to move towards, it's already in the 70s, right? It's going to move towards the 80s. So you need to start saving for that age, right? Our ancestors, maybe our great grandfather didn't have to save for that, that period, right? I mean, they would live, work, and then maybe in urban areas, death would happen at the age of 60 or thereabouts. In rural areas, maybe at a at a lower age, right? So that's the key message. Aging population is going to go up. Average household size, right? पहले सब joint family में रहते थे, मोहल्ले में रहते थे. You would know every neighbor that you would stay with. There were extended families, chacha, taya, mama, grandchildren, children, everybody together. Now it's even difficult to find, especially in urban areas, children staying with their parents, right? So what does this mean? I mean, this has implications, right? In some sense, पहले वो 3 BHK में सब रहते थे, अब 6 BHK चाहिए ना, because nuclear families have got created, right? So in some sense, that is also a bit of a lifestyle creep. I think one of the success stories that India has done, and in India everything takes time, okay? 20 years, I think in the late 90s, there was this report which came up on pension reforms in India. That is when the national pension scheme, or the national pension system as it was called then, it was developed, right? It was rolled out first for the government sector employees and then also for the private sector employees. It is the cheapest way to kind of save for retirement across the globe. So you can't, as a fund manager, you're not allowed to charge more than 0.09%, right, of the assets under management, right? And you can start, once you start working, you can start investing in that effectively. Right? So it's a great vehicle. Now, of course, I mean, you may not be able to pull out all the money during your working years and all. So it is clearly meant for the purpose of retirement, right? You can't literally use it for any other purpose, and which is a good thing, right? I mean, at HDFC Life, we have a pension subsidiary, HDFC Pension Fund Management, and I think it just completed 10 years a few years back, and now the corpus is already closer to 65,000 crores, right? Which means that the awareness and the nudge by the government, right, to people to save in the NPS, all that is kind of helping. So people have started planning for retirement, but a lot more awareness can happen, right? And so let's move ahead just quickly. Yeah, I spoke a little bit about that. Joint families moving to nuclear families. Yeah, I mean, this is the standard inflation slide. You would have seen it in the previous presentation as well. So if your monthly expenses are whatever 10,000, even if you assume 6% inflation, right, which is pretty much, let's say the economy grows at 6%, inflation historically in India has been at those kind of rates, right? So it's a safe assumption, it's a conservative assumption, right, without accounting for lifestyle creep. But if with every, let's say, uh, launch of a new phone, you're going to upgrade your phone every 3-4 years, then this 6% is actually going to be even higher. If you look at things like medical inflation, for example, right? Medical inflation in India is amongst the highest. I mean, there's a very interesting chart. If you look at the US, right, the price of TV has gone down. The price of, let's say, internet has gone down. Price of pretty much everything has gone down, except two things. Any guesses what those two things are? I mean, one is medical expenses. Which is the other one? Sorry? Education. Somebody said education, right? So education and medical, because you can't outsource these both education and medicine, healthcare to countries where the labor is cheaper, right? I mean, I was speaking to a colleague a couple of days back. His father was undergoing a cataract operation, and he told me the price of the lens. Now that has increased 10 times. You know, when my parents got that lens, that price has gone up 10 times in about 7-8 years, maybe, right? So what was 30,000 lens is now a 3 lakh rupee lens. So medical inflation is actually more than 6% because, if any of you kind of tracks the pharma industry or the hospital industry, right? Let's compare hotels versus hospitals. Whenever you do an airline booking or a hotel booking, you go online, check the pricing, etc., right? And then decide whether it fits into the budget or not. So in some sense, you are setting the price. I mean, the price is available, but you are making the decision at what price to go. When you go into a hospital, who sets the price? Hospital sets the price. You have no control over that, right? So all you can do is have adequate insurance against that, right? And part of the thing around riders is insurance companies offer, let's say, a critical illness rider, or health insurance companies have, other riders, right? So, I mean, you can, for, let's say, ailments like cancer, HDFC Life has a cancer dedicated product called Cancer Care. Or you have a product for heart ailments, right? Heart surgeries, etc., which is the cardiac care product and so on and so on. So you can buy some of these standalone products or buy them as riders along with the insurance policy. Yeah, and this one, of course, we're not as developed as the Scandinavian countries where you pay 52% tax, but the government kind of takes care of your healthcare and education. In India, pretty much, there's no social security, right? So you have to save in a vehicle for your own retirement planning. You can't be dependent on the government. The government can, of course, facilitate through some tax incentives for long-term planning and so on and so forth. Okay, some insights on retirement planning, right? So what is the biggest worry that people have about a retired life? First, of course, is the rising healthcare cost, and we spoke a little bit about that. The second is also about, once we grow old, we'll have all these issues and, we'll need to spend a lot more on medicines. Third is you will not be able to work, right? So you lose financial independence. So how do I get that income, right? That retirement gap that people start thinking in their 50s, you have to start planning for that in your 30s or your 40s, right? Most people realize it pretty late in their lives, right? And of course, there are other reasons which are mentioned there. Reasons for not actively saving for retirement, right? सबको लगता है कि बहुत पैसा है फ्यूचर के लिए, right? But you don't plan for medical inflation, you don't plan for lifestyle creep, maybe you don't save enough, right? But the second one is very, very important. Don't have sufficient knowledge. Don't have the right advice. Who do I go to for advice, right? Not everybody is equipped to. Sorry? Not everybody is equipped to kind of, get the right advice, right? So how do you kind of figure out that there are simpler instruments that you can invest in for a longer term perspective, right? Most people would think a PF is good enough for retirement, right? Now, what do people want, right, during their retirement? मतलब security of capital is nicely put, but पैसा मेरा डूबना नहीं चाहिए. That is the first thing, right? I want this money which I have earned during my working years. I worked for 30-40 years. I want that money to be secure. That is the first ask, right? So, and therefore, even when I look at my own parents, they're happy putting money in a senior citizen scheme, in a fixed deposit, in a savings bank account. Nothing to do with India growth, equity markets, nothing. Needs are simple. I don't want my money to go down, right? The second is tax benefits. Tax benefits means कि tax भी नहीं लगना चाहिए, अब तो retire हो गए हैं तो हम क्यों tax भरेंगे, right? But the government's job, of course, is to maximize the tax opportunity. So beyond certain thresholds, everybody has to pay tax, right? And continued income after death, basically for the spouse, right, or a family member, right? I don't want to give up that money to let's say an insurance company or to the government, right? I want that money to come back to me. In insurance parlance, it is called the return of premium, right? So my premium has to come back to me, the base corpus that I have put. Low fees and charges, and the list is kind of going on. People want income guaranteed, right? A lot of people, talk about, keep growing your wealth, etc., by investing purely in equities, right? But if you look at the customer mindset, they're looking for guaranteed products. I mean, there's a reason for that, and there's a historical reason for that. Why do Indians invest a lot in gold and real estate? I mean, historically, and you can go over hundreds and thousands of years on this, they've pretty much moved in line with inflation over an extremely long period of time. So people are comfortable with that. You own that asset, gold you can keep at home in your locker and so on and so forth. So a lot of people are still wedded to guaranteed products or products with a long history, thousands of years of history of continuing to beat inflation, right? So therefore, India is a lot less financialized than some of the developed markets that you have seen. So in a lot of people's minds, that gold, that real estate is going to pass on to the next generation, right? And not just 40 after 40, they are maybe thinking, 40 generations after 400 years, right? So that's the way people think, and then there's a long list of other areas, right? So I mean, basically recapping what I just spoke about, medical exigency is the first thing that people think when they grow old. They want financial security for self and spouse. Return of capital should happen. My money should not go down. I don't want the volatility of an equity market. Third, we are Indians, right? Family always comes first. So child's future is more important than our retirement goals sometimes, right? That's how very often young Indians think. I'm not talking about older Indians when your kids have grown up, right? But for many young Indians, the trigger point for starting to plan for retirement is after their child has gone to college, right? The child goes to, when I say college, after 16, 18, 20 years, right? When they see they just have 10 years of working life left now we have to start planning for retirement, because all our years we were either, there was the discussion on home loan EMI pre-closure should happen, not happen, and all of that. You're either burdened with the EMIs or you're planning for the child's future. So retirement planning actually comes fourth in the list of priorities, right? So the first two, basically they're saying liquidity chahiye for any medical reasons. Second thing, they're saying self and spouse. Then comes child, and then acha retirement mein kya hoga wo baad mein dekh. So that's number 4, right? So, and these are all surveys that we've done. So I think, what does retirement planning mean? We tried to kind of define this here, right? So there are 2 phases to retirement planning. सबसे पहले तो retirement goals क्या है? I mean, basically some of that has got captured, and I think the people in this room will also probably resonate with what the wider customer base has spoken about. But it is a systematic process of deciding the goals, right? कितना corpus चाहिए आपको? What will be your requirements, right? And some of it was tackled through those calculations and other slides which were shown in the previous presentation. But basically, irrespective of the age at which you are, you should have a separate financial plan purely for retirement goals, right? And mathematically, based on all the studies and which have been done over the world, I mean, there are mathematical formula which can act as a thumb rule in terms of how people should plan for retirement, how you as individuals should plan for retirement, and then of course you build the roadmap to achieve these goals. So, what does it involve? So once you sit, right, see I mean, my golden rule, right, of financial planning is you should be able to sleep well at night. Okay? So whether it is equity, debt, government bonds, fixed deposits, savings, insurance policies, whatever, gold, whatever assets or mix of assets that you as an individual choose, you should be able to sleep well at night. If you're not able to sleep well at night, your financial plan is in some sense wrong, right? Because you're not happy with that kind of financial plan thing which has happened, right? So the first one is fund accumulation. So during your working years, typically, obviously you accumulate for your current lifestyle, but a part of the corpus definitely needs to go for what you can call extremely long-term planning or retirement planning. And it's not necessary that you might need to work during your retirement years. I mean, there's this whole concept of FIRE, right? Financial independent, retire early. It's called FIRE. It's a movement in some sense, right? I mean, a lot of people who earn well during their first 10-15 years of working life, right? They believe that financial independence is the goal. They strive towards it. By the time they're 35, 36, 40, they say, okay, I've had enough of corporate life and so on and so forth, and I'll kind of manage my life based on my own terms and conditions. That's the concept behind FIRE. The second is consumption of funds, right? Abhi retire ho gaye hain, to humko consume karna hai funds. And third is providing for healthcare, right? Which of course is top of mind. But there's a paradox of choice. So if you look at the options that you have, paradox of choice essentially means that there are so many options that we all get confused, right? There's central and state government, right? In our heads, basically, gratuity, leave encashment, all these things act as surrogates for retirement planning. ये तो हो गया ना, मेरा gratuity हो गया, leave encashment से पैसा आ जाएगा. There is some deduction which is happening for NPS, either by my employer or I am doing it on a voluntary basis, right? So that's an option. And EPF, VPF, superannuation fund. So there's a long list, right? Then there is the PPF, which the government keeps on declaring rates at regular frequency. Fixed deposits because you want liquidity, you want the money to lie with your neighborhood branch, right? So that in case of an emergency, you can withdraw it. There are traditional savings plans by life insurers, unit-linked plans by life insurers. If you want equity exposures, if you want guaranteed products, then you go by traditional savings plans. If you want an equity exposure, then there are unit-linked plans. And then, of course, there's the national pension system, right? So, kahan save kare? I think that is the fundamental question, right, out there. So, I'll focus on the life insurance offerings and associated pension fund offerings that at HDFC Life Insurance we have. So, in the accumulation phase, basically, you have two key vehicles. The life insurance offerings. The traditional savings plans, as they are called, right? Now, the underlying asset, right, as I spoke before, you should choose based on your risk appetite, which I define at you should sleep well at night. Okay? So, whether you choose for a guaranteed product or you choose for an equity-linked, unit-linked pension plan, unit-linked investment plan, that is basically a personal choice in my view. Right? Asset allocation 50-50, 75-25, 80-20, 20-80, it's all a function of the individual's choice, right? Because every individual is different, your lifestyle is different, your requirements are different, your risk appetite is different. So that's accumulation happens typically during the working years. And consumption means now I need money, right? I've saved this money for my retirement. How do I get that income in a structured manner on a monthly basis, on an ongoing basis, on a annual basis in some cases, but typically prefer preferences for monthly basis, right? So these are called annuity products. It's not a big market in India right now, retirement planning. As we saw from the initial graphs, right? The ratio of retirement assets to the retirement gap is very huge, right? A, because people are not saving enough, but people who are also saving are not necessarily buying annuities right now. They are keeping a lot of money in fixed deposits, savings, neighborhood branches, and so on and so forth, right? you should keep only so much money that is required for liquidity in those kind of instruments. But an annuity is a good product where you can get guaranteed returns. So you can lock in interest rates, right? Why is it an interesting product? We'll speak about it later on. I mean, most Indian households have everything else: PPF, a little bit of FD, a little bit of real estate, gold, senior citizen schemes, etc. But there's an interesting product called Annuity, and in India right now we only offer what are called fixed annuity products, or products which give you fixed returns. In some of the developed markets, of course, you have variable annuities where you can again link it to an underlying index. Underlying index means you can link it to a Nifty index, or you can link it to a gold index. Depending on how that index goes, your retirement corpus can also keep fluctuating. Of course, it's largely, it's, if you want structured income, then a guaranteed annuity works. If, of course, you are willing to, you're still looking for growing your wealth and you're okay with some volatility in the income which comes, then variable annuities are useful. They're not yet there in India, but I'm sure over the next couple of years, you should expect a product like that. Yeah, so just getting into some details of annuity, right? So definition one here, you get a fixed amount of money from the insurer for the rest of your life, right? In return for a lump sum payment. So you retire at, or whenever you want to put that money, right? You can put that money, give it to an insurance company, and you can, you enter into a contract with an insurance company, you pay a lump sum amount, and the insurance company guarantees you a certain monthly income. इसको आप reverse of EMI बोल सकते हो. इसमें insurance company आपको equated monthly installment में पैसा दे रही है. Think of, typically in a loan you pay an EMI to the bank. In an annuity, it's the insurance company which has taken your corpus. In some sense, you have lent that money to the insurance company, and the insurance company is paying you an EMI. The thing about an annuity monthly income is it is guaranteed, right? And you can lock in the interest rate today. So let's say, and in India, what is the typical, let's say on a government security, what is the interest rate today that we are earning? Maybe about 6.5%, 7%, let's say, is in that range, right? It varies from 6.5 to 7.5, somewhere in that range, right? Is that right? So today, if you buy an annuity product, you can lock in that interest rate, okay? So basically, आप क्या कर रहे हो? Interest rate risk you are transferring from your personal balance sheet to an insurance company's balance sheet. What is the job of an insurance company? The job of an insurance company is to manage risk, right? So first is, it can give you life cover, which means if you were to die, your claimant or your nominee will get the income. If you fall sick, you can file a claim and get a health claim. Morbidity risk is managed. The third risk is longevity risk. You are living longer, you don't have enough money, and so therefore during the accumulation phase, you can save in life insurance plans. And the other one is interest rate risk, right? Today in India, interest rate is 7%. Tomorrow, let's say it goes down, right? Because of some RBI policy or whatever, the way the economy develops, the interest rate keeps going down, right? Let's say it's 10 years down the line, that interest rate is 3%, right? Now you have saved so much for your retirement corpus. But 10 years down the line, you will get only 3% on some of the other instruments that I spoke about, right? I'll just go back. So your PPF, which is probably paying 8% today, might be paying you 4% at that stage, right? Your fixed deposit, which is probably coming to you at 7%, 6.5% today, might pay you 3.5%. Your savings account, which is paying you 3.5%, 4% today, might pay you 2%, right? You look at all the developed economies, right? The US was literally Japan is operating at 0.1% interest rate. Japan has the highest ratio of dependent people to working age people, right? In India, we are maybe 30-40 years away from that stage. But as we reach there and interest rates fall, this retirement bomb will actually explode there, right? So a lot of people, India average age is 31, right? Or 29 right now. A very young demographic. So people do need to start planning for retirement right away. A, in terms of growing the corpus during their working years. B, because if interest rates goes down, you will not be able to protect your corpus, right? You're basically putting a corpus 3% return on, let's say, even if you put ₹1 crore, right? You'll get 3 lakh rupees back in terms of interest rate. If interest rates go down, today you're probably going to get about 7 lakhs per annum back, right? Which is about 50,000 per month, which I think is sufficient for, let's say, a middle class average household. I'm not talking about affluent, upper middle class, uber rich HNI households, but for an average middle class household, I think it's fairly sufficient. So hedging of an interest rate risk is what an insurance company does. Not just for you, but most annuities which are sold in India are joint life annuities, right? You also want your spouse, because this, I mean, mostly in India, 3/4 of insurance policies are bought by males, right? Only 1/4 are bought by females right now. So in an annuity, and the female is also younger, typically on average 4-5 years, right? Plus females live longer by 5 years, right? So I mean, you essentially have to ensure that not just you as a let's say a male breadwinner in the family, but also your spouse is taken care of, not just during your retirement, but also after your retirement, after your death, like in some sense, right? So joint life plans are typically taken. Capital preservation is ensured, and it acts like a legacy planning tool. So return of premium happens, and your nominee can get the corpus that you have given to the insurance company, right? I mean, that's the variant that most people buy in India. Of course, there are plans where you don't want anything back from the insurance company. You say, I live long enough to recover my capital from the insurance company, right? Yeah, so I mean, I spoke about interest rates going down. It competes with other asset classes today, but a lot of them are volatile, either in the short term or in the medium term, right? So, I mean, yeah, stocks. I mean, people say, okay, invest in stocks, but it's very, very difficult to build a portfolio, right? Typically, most of it is outsourced to a fund manager. I mean, to be successful in the stock markets, I think there's a guy called Phil Carrot who said 3 things. One is you need to have the vision to see which stock will do well, right, or which company will do well. Stock to baad mein aata hai. Second, you need to have the courage to buy, right? Assuming you have the money, then you need the courage to buy, and then you have the patience to hold, right? I mean, and patience to hold over 20, 30, 40 years, right? Very, very difficult for people to do, and therefore a lot of the money management gets outsourced to large institutions like HDFC and fund managers, right, to do their job, right? But you have to live with volatility, right? Even, I mean, if let's say you had invested in an entertainment company stock, I mean that stock went down 30% yesterday. Can most people risk their retirement corpus with that, right? So we have to be really, really careful when we are talking about retirement corpuses, right? Creating a retirement corpus. Yeah, I mean, if of course you are looking for some wealth growth or some, I mean, I won't call it gambling, but you're taking a punt, then it's okay, right? Some part of the money you're doing that, it's okay if you're directly dealing in stocks. But for retirement, it's advisable not to take that kind of a risk, because what goes up very, very fast also comes down very, very fast. So yeah, I've spoken about retirement. I think just some numbers, and I think every session which is happening is speaking about this in different forms. I think the core message here is starting early. I don't think there are many 25-year-olds in this room, but if there are, I think you should have a look at this chart. So monthly contribution of 5,000. Let's say somebody's earning 50,000 a month. We are saying a 10% corpus, right, goes for retirement planning. Just 5,000 rupees a month on a consistent basis. Yeah, you invest in a decent vehicle, and this is a very aggressive 13% return. I think the reason it was taken was, let's say the Indian economy grows by 6-7%, and you have inflation growing at 6%, and typically blue chip companies can potentially give you anywhere between 9 to 15% kind of a return, right? I mean, that's a safe assumption to make there. So 13% has been taken there. Retirement age is 60. Right now, let's look at what happens. If you start at the age of 25 with just investing 5,000 on a steady state basis, right? I'm not even saying your income will go up based on per capita income going up and all of that, right? Just 5,000 straight line getting invested between after you turn 25 till the age of 60, right? You'll have a corpus of 4.22 crores. If you start at 30, it literally halves to 2.19. And with every 5 years, that number is halving, right? So 4 crores, 2 crores, 1 crore, 50 lakhs, 25 lakhs, 10 lakhs. It's now read it in the reverse order, right? मतलब वो 12 लाख 4 करोड़ हो सकता है. Now, what is the value of 4 crores 60 years down the line? At least it has beaten inflation because you've assumed 13%, right? It's actually done that job, right? So, mathematically, it is a very, I think younger people should start doing this very, very early. And again, agnostic of the instrument. Just save 5,000 rupees per month in an instrument that you're comfortable investing in. And for people who've got a corpus, of course, I spoke about annuities. You don't have to kind of deal with a lot of volatility, at least for a part of your portfolio, right? Yeah, of course, some portfolio can always be diversified. And, there's this concept called the permanent portfolio. So you don't have to look at asset allocation. I think it was done by a guy called Harry Brown. So he said 25% in stocks, 25% in cash or any liquid instruments, 25% in gold and real estate, and 25% I think it was in bonds, right? So that is a permanent portfolio. You don't have to think too much every year about it, to do asset allocation and all of that, right? And that I think in the US is anyway given 10% return over a long-term period of time. So if the Indian economy kind of mimics what has happened in the US, then without doing, once you do this asset allocation, it is called the permanent portfolio because you're not tweaking it again and again, right? So you have liquidity. You have liquidity from, let's say, cash and fixed deposit saving instruments. You have investment in bonds or government securities, which are relatively safe for the medium term perspective. You have gold as a hedge against inflation, and then you have everything else, right? Those are the 4 parts. Yeah. So another interesting thing that only life insurance companies offer. Okay. By the way, annuity is only offered by life insurance companies. Nobody else offers an annuity, right? A bank cannot offer an annuity. A chit fund cannot offer an annuity. An NBFC cannot offer an annuity. Even the pension fund management companies don't offer an annuity, right? Only a life insurance company can offer an annuity product, so it's unique to a life insurance company. Similarly, riders, right? These are products which are again offered only by life insurance companies. When we speak about protection plans, right? Some of these, like we may buy a life insurance policy, but we may forget to protect ourselves against a critical illness, for example. Now, let's say I've entered into a contract with a life insurance company to pay 20 premiums over the next 20 years, right? And I'm investing it either for my retirement or let's say I'm investing it for my child's education, for example. Now, what happens in the case something happens to me? Of course, there's a policy where I get a claim, but I was saving this in this instrument for my child's education, right? What happens in that case? So there's a rider called waiver of premium. So let's say if the individual dies, the insurance company will pay the premium on behalf of the individual in that policy, and your child or nominee will get the corpus at the end of the policy contract, right? So essentially that's what the waiver of premium does. Income benefit on accidental disability. Let's say you lose a job, you have an accidental disability, who will pay the premium, right? This rider allows you to kind of, of course, you file in a disability claim, the insurance company will then pay the premium in your policy, right? That's the whole objective of an income benefit on accidental disability. And in some cases, you can get structured incomes streams also, right? The third one is critical illness. Let's say you're diagnosed with a critical illness and, you have this rider, right? Again, waiver of premium or income streams can be created as part of that. Critical illness riders. So these are some riders which are there. Of course, there are other riders like you can have a cancer care rider, or you can have a rider for various other purposes, right? So that's the objective of how retirement and riders go together, because a lot of retirees do care about financial exigencies, about medical exigencies and security, right? That's where annuity plus riders together becomes a very, very powerful combination. The core messages, I think, start early. You may start small, but do start, right? I think allow the effect of the power of compounding to kick in, And I was so since we're talking about the power of compounding to kick in, how does it kick in, right? And Deepak Shinoy was on the panel. He runs his Capital Mind. Yeah, I think that's the name of his firm, and he's very active on social media, Twitter, and all of that, right? So he was saying his father had bought a set of shares in 1997, or had a set of shares when he died in 1997, and of course it went to his mother. His mother was not trading, and so on and so forth, right? Out of those 40 companies, apparently only 7 survived, right? But yet the corpus was 40 times, right? That's the power of compounding, right? I think when my father had moved to Bombay and he had bought a small flat, he had paid 1 lakh rupees, right? Now it was almost 45 years back maybe, but the value of that flat today could be probably 1.4 cr, 1.5 cr. So don't interrupt. See, the first rule of compounding is don't interrupt. Okay? Don't interrupt. Right? Even if you are investing in stocks, right? Remember this formula called ODD, right? One is only buy good companies. Now, of course, you have to define what a good company is, and there are rules around that. Second is, first is only buy good companies. That's the first thing. The second thing is don't overpay, right? Now, again, partly it is science, partly it is art, right? So it is your call, right? If you are overpaying or not. Third is do nothing, right? So let the power of compounding take shape. Stocks go up and down, but the good companies typically over a period of time tend to do reasonably well, right? But and with a diversified portfolio, if you can't do it yourself, of course you outsource it to a fund manager in an insurance company or a mutual fund or a pension fund company, wherever you want to outsource, right? But don't interrupt it. I think whether it is in real estate, whether it is investing in gold, whether it is in a pension scheme, insurance company, don't interrupt compounding. The second piece I've spoken about, diversification. But if you're looking for a stable stream of cash flows, right, go for an annuity. If you think you've got reasonable corpus, even at the age of 45, for example, right, आपके पास decent corpus आ गया है और आपकी income चल रही है, आप retire 60 पे होने वाले हो, तो what you can do today, आपको अगर interest rate lock in करना है, you give it to an insurance company. Okay, the product is called a deferred annuity. So the product that I essentially spoke about is immediate annuity. आपने पैसा दिया insurance company को, you start getting your income stream immediately after a month or 1 year, right? Depending on how you structure. In a deferred annuity, you can postpone the annuity. You have the corpus today. It's surplus money. You want it to be safe. You want to lock in the current interest rates which are available, right? And therefore you transfer it from your personal balance sheet to an insurance company's balance sheet to manage that risk. So that is called a deferred annuity. And that is a product stream which is again picked up very, very well in the last 3 or 4 years. And you can defer it based on your requirements. You can defer it by 2 years, 5 years, 10 years, 15 years, right? It's totally up to you in terms of how long you want to defer that. But you get a stable stream of cash flows. It's guaranteed. The insurance company cannot exit that contract. Okay? Everything else is on paper, right? कि 13% growth होगा तो ये compound होगा, यहाँ पे inflation इतना होगा, interest rate इतना होगा. That's all like we are all predicting like Nostradamus, right? What is going to happen? I mean, nobody can get it right. But in an insurance contract, once you enter into an insurance contract, you have obviously given the money, so you can't back out because you've given the money. The insurance company cannot back out. It is like regulatorily, an insurance company is to ensure that you get that income stream based on the contract. If you want immediate income annuity, it will start immediately. If you want deferred annuity based on the contract, you can decide the period when that money has to come. And of course, whenever you buy a retirement product, don't forget to attach a rider, because the topmost thing, and whether it's an advisor or whether you're listening as a customer, riders are really, really important because it takes care of the financial and medical exigency or anything else that might happen in terms of disability and so on and so forth. So I guess that's the summary of the presentation. Thank you so much for the presentation and for being a patient audience. I think there are questions.